Hey, good morning, everybody. Traveling today, picking up my daughter. She was doing an internship in Knoxville, so I'm sitting at a Starbucks not far from her place as my wife and two daughters are packing her up. So great excuse to get out of packing her up, which is always a good thing. Anyway, I'm glad you could make it. So this could be a little louder than usual. There's a pretty busy road in front of me. And of course, you hear the trucks, people coming in and out of Starbucks. So I apologize for that, but this was kind of the only way I could make it work. Anyway, today I'm going to talk about kind of a unique ETF that I'm looking to put into portfolios, and they're called buffer ETFs. So, I've been underweight equities this year, and it's been a bad idea. I mean, equities have had at least on the 8 tech stocks and some of the, the meme stocks, things like that, have had a really good year. So the market overall, it's pulled it up. But, and I've said it, I look at technical factors, but economic factors too. And the reason is, kind of twofold that I've been underweight. One, all of the economic indicators are kind of lining up exactly like the past couple big recessions we had, 08 and 01. And then secondly, I'm just kind of looking at a 30,000 foot view here that over the past, really 15 years, 14 years, markets, real estate markets, stock markets, bond markets, pretty much every investment asset class has done really well because of an influx of liquidity, just cash coming into the system. So we've had a massive amount of liquidity come in, and now we're in a position where they're pulling that liquidity away, whether it's the Fed by raising rates and reducing their balance sheet, or banks are really pulling back on their lending. It's getting a lot tougher to do lending. And not only that, but the demand for lending is dropping because of the higher rates. So, when you have that situation, if you had something that's been boosted by liquidity, what happens when you take that away? I mean, you seriously suspect that it's going to continue on its path. And then you couple that with some of the economic indicators heading south, and, things, nobody knows for sure, but it just doesn't kind of look all that great. So we'll jump into some of these slides and I'll talk about these buffer ETFs. So what is a buffer ETF? I'm going to turn this camera off. So real quick on the agenda, we'll talk about buffer ETFs and got a couple questions on the U.S. debt downgrade, and then just a question on inflation from folks. And I'm going to finish off with just a little Taylor Swift effect on economies, talk about that. So, okay, what's a buffer ETF? So buffer ETF is basically using options to try to give you a more consistent and knowable outcome. Okay, these have been around for probably since 2016, but they were in what they call separately managed accounts. So you kind of have to move it over to the actual investment manager. You can't just buy a holding and have it. But sometime early 2020, they came into the ETF format. So they're still very new, but they're again based on options. And a lot of times when people hear the word options with their investments, they think that of risk, because I think everybody's known somebody who's blown themselves up with options. Options are something that can be used for accelerator returns, or they can be used as insurance. So the way I'm looking to do it is as insurance. So basically what these things are going to do, they're going to these funds sort of act like an insurance company in a couple of different ways. So, when you have your home insurance, you pay 1 or 2% of the value of your home every single year. And what you get in return for that is protection against some sort of catastrophic event, a tornado, a hurricane, a fire, things like that. Now, if you get to the end of the year and you haven't filed a claim, well, that insurance is gone. So, you keep paying that every single year. So that 1 or 2% that you're paying every year is just kind of dwindles away. But if you do have that fire or tornado or something, you have kind of an asymmetric upside on your return from that small 1 or 2% premium. So that's sort of kind of how options work as well for the stock market. So there's two ways you can use options for the stock market. There's things called call options and things called put options. So a call option is associated with the price of the stock or the index going up, whereas a put option is just the opposite. You're expecting the price to go down. Now, these buffer funds, again, what they do is they use options to kind of figure out or at least minimize the downside. Now, to do that, they also end up giving you sort of an upside potential, but you are capped with it. And I'll get into the details for a second. So this is a lot like these equity index annuities you hear annuity salesmen try to sell all the time. You can't lose if the market goes down, but you're going to make money when it goes up. Well, the problem with those products is all the academic studies have looked at it and said when you really get to the bottom line, you're only making essentially what a money market would make because there's lots of fees with it, and they really cap your upside potential quite a bit. Now, they do protect on the downside. So basically what these buffer ETFs are doing is they're taking the technology or the investment philosophy of the insurance companies and getting rid of the insurance company overhead. So this is exactly how these insurance companies manage the money when they handle these equity indexed annuities. So it's basically creating that with just a way lower cost and more upside potential. So again, you'll kind of know what your maximum upside potential is going to be anytime you buy one of these. You've got a buffer on the downside. And then it's based over really a 12-month period. There's an outcome period. All options have time periods. So, you could buy an option that expires tomorrow. You could buy one that expires in a month. You could a year and so forth. But most of these that I'm looking at are 12 months in duration. And then they talk about reference asset here. Now, there's a lot of different asset classes now that you can get access to. They've got the S&P 500 is the most popular one, of course. But they've also got the NASDAQ. They've got small cap stocks. They have gold. They have international developed. So there's a lot of different asset classes you can access with these buffers. Now, the big thing is, do you really need this downside protection? Because the one downside for these funds is, if I'm using a Vanguard total stock market, we're paying 0.04% annually. There's very little cost drag to your performance. But when you throw in these options with it, you're looking at probably about a 0.7. So from 0.04 to 0.7. Now that's obviously a lot more expensive, but I say, look, you're buying insurance here. It's no different than your home insurance. You're just doing it for your portfolio. But, for the most part, everybody knows that the market typically is going to go up. This chart just shows you from 1950 to 2022, how many down years the market has had and what the severity of those market downturns were. So, you've only got about 5 years where you're talking probably 20% or more on the downside. So now some of those downsides can be pretty big, but again, what I'm looking at right now is, I just don't trust this market based on economic indicators. I mean, it doesn't mean that things can't turn around or something like that. But again, we've got a lot of factors showing recession, and we also have tons of liquidity being pulled from the market. That's not a good duo to be dealing with. So, I'm looking at this as a way, okay, we can expand our equity exposure, but then try to protect us on the downside. Just to give you kind of an idea, there's different buffer levels that you can get into. This one is a 10% buffer, so it will protect the first 10% down in the market. And again, if you look up here, a lot of the majority of the losses, calendar losses for the S&P 500 were around 10% or less. So you're covering quite a bit of your downside, which is this 10% buffer. But the way it would work is, in this example, they're saying that the performance cap is at 20%. That means you'll participate to the upside with the market up until it hits 20%. So if the market goes up 30%, you're only going to get 20% of that. But you have that 10% protection to the downside. So again, if we had a really bad year, let's say the S&P 500 goes down 20%, well, you'd be down 10%. The first 10% completely protected with this 10% buffer. And then you'd have a dollar for dollar loss thereafter. Now, if the market only went down 10%, then you would be flat for the year. You wouldn't have any loss. On the upside, this example looks at, all right, what if the market's up 7%? Well, you would have 100% participation with that up to the 7%. But then if the market went up, say, 25%, in the last example on the far right, you'd be capped at that 20% performance cap. And now all these caps, all this stuff changes based on the pricing of the options. So, this is an example, but typically right now for a 10% buffer, you're seeing around 20% upside potential. That can, again, obviously change when volatility picks up, options become more expensive. So that to get that performance cap up that high would be awfully costly. So they probably would have a lower performance cap. But it all depends. So it's something that fluctuates. This is just examples. The second buffer that's typically seen a lot is a 15% buffer. Now, since you have a bigger downside protection, your upside is going to be capped a little bit more. And I'll explain in a second exactly why. But just know that if the more protection you have on the downside, the less upside you're going to have due to option pricing. But in this case, we'll look at, all right, if you start at the far left and you say, all right, the negative scenario where the buffer's exceeded, so the market goes down 20%, you would still be down 5%, but you'd have 15% protection on that. And then if you move in and look at a negative scenario, but you're still in the buffer range, so the market's down 15%, well, you're flat. You'd be at a 0% gain on that position. And then obviously if the market goes up 7%, you would be up 7%. But if the market went up, say 20 or 25 or 30% in a year, you'd be capped at that 17% performance cap. And then finally, they also have a 25% what they call their deep buffer. So this is the deepest buffer that you could have. Now, this one works a little bit different than the other two that we just talked about for the downside protection. In this case, in order to make the pricing of the options feasible, you experience 100% to the downside for the first 5% of the fund. And then from 5% to 30%, you're protected. Okay, so in this case, if you look where it says negative scenario buffer exceeded, so if the market went down 35%, in this case, you'd be down 5%. Or I'm sorry, you'd be down 10%. Okay, so you've got protection from -5 to 30%. So you experience the first 5%, 100% to the downside. And then that last, from down 30 to down 35, you'd also experience that. So if the market went down 35%, in this case, you'd be down 10%. Now, if, say, for instance, the market went down 10%, you'd still be down 5% because, like I just mentioned, the first 5%, you're going to experience 100% downside with it. But you still have some protection there, so you still have something. Now, if the market was just down 30, you'd only be down 5. So that's the way you kind of look at that. Now, the positive scenario is kind of the same thing. If the market was up 5%, you'd be up 5%. But if the market was up, 20 or 30%, you'd be capped at that performance cap of projected to be 15%. So you don't get as much upside protection here, but there's a lot more downside protection with these buffer funds. Okay, so how do they do this? And this might, I titled this technical jargon. This is sort of it might be too much to understand, but again, think of the insurance example, your home insurance. Now, you are the insuree. You give that 1 or 2% of a premium of the value of home to premium to the insurance company. The insurance company collects that premium. So they make some money by selling that insurance to you. So instead of insurance, just think of either puts or calls. So the way to make these buffer ETFs work, you have to act both as the insuree and as the insurer in different ways. So at the very top, we'll start with that because that one's kind of easy. So we talk about these performance caps, the upside potential that you have with all these buffer ETFs. So the reason you have this cap is they try to minimize the cost of buying this insurance. What's this total insurance cost going to be? So they're going to, like I said, be the insurer and the insuree. So they're going to look at all the different ways that they can try to keep this as close to zero as possible in cost for you, or keep your costs very low. As I mentioned, there is a higher cost for these ETFs, but and that's part of the premium. So you're paying for those premiums. So the first thing that they do is on the upside, they figure out the right spot to maximize call premium, acting as the insurance company. So they sell call options. So there's going to be somebody buying protection from the ETF. So the ETF is going to sell it, these call options, and they'll collect that premium. Now that premium then that they just collected is going to be used to offset the cost to buy our put options, our protection. So if you look at the top, you see sell 15% call. That's exactly what they do. They sell a call. So that just means that if the market goes above, grows more than 15%, whoever bought that option from the ETF provider, they get the benefit above 15%. So if it goes up 25%, they come back to the ETF company and say, well, we bought this premium from you. You have to sell it to us at a 15% rise instead of the 25% that's there, that the market actually earned. So basically the premium we collected, again, helps to offset the put options we're going to buy. And that's where you go from A to B down here on this chart. So we're going to buy a put option. So here we're acting as the insuree, not the insurer. So we're buying the option. We're giving that premium to another party. And what that will do is if the market goes down from 0 to 10%, we're completely protected. So that's buying options is oftentimes more expensive than selling options, especially if you're trying to get protection like from the current price to down 10%. And again, I don't want to get too much into the options here, but because it is a complicated issue. But what you need to know is, all right, we sold some call options, we collected that premium, and now we're going to take that premium and use it to buy some put options to give us protection for the first 10%. And then what we do after that from B on, you're just going to experience the downside after that point. So that's how that option would work. So we sold premiums, call premiums, took that money and bought some put options to protect us from 0 to 10. And then after 10, we're going to experience a downside dollar for dollar. That's the 10%. Now, it also does it for the 15 and the 25% deep buffer. So it's all basically how this thing works. And then to give you an idea, like I said, most of these buffer ETFs are over a 12-month period. And if you look at this, this is the 15% buffer. The lighter line here is what would be the reference asset, probably the S&P 500. So this is trying to show you if over a course of a year the market's down 15%, what would it look like for your buffer ETF, that 15% buffer ETF? Now you can see the dark line is the buffer ETF. And what's interesting, if you look at it, there's still a lot of volatility from day to day to month with the buffer ETF. You think, well, I bought 15% protection, I should just not experience anything to the downside until the market's lost more than 15%. But that doesn't happen that way. You don't get back to that full 15% protection until you get to month 12, until the option actually expires. That's why you have volatility in this. So if you sold it at month 6, you'd actually be down about 6%. That's all due to what they call option decay. So the option is for 1 year, just like your home insurance is for 1 year. You basically have to hold it you got to hold it that whole period in order to have the protection that you want. If you sell it before then, not that you can sell your home insurance, but you can sell these options anytime. But if you sell it before you get to the end of the premium, it may be selling at a discount to what you bought it for. So it shows you that there is volatility with these, but if you hold it for that full year, you get that full protection. The vast majority of options, it's the last month is where you see really where it comes close to its true value. If you sell it anytime before that, you're subject to, there's still there could be 6 months left on that option. So a lot can happen in that 6 months. So the option gets discounted quite a bit. Again, I think I might be getting in the weeds here, but the big point that I'm trying to make here is that if you hold it for the full year, you get the full experience of that buffer protection. So in this case, the market goes down 15%. And in December or the month 12, you're at 0. So you've gotten that full protection. Whereas the reference asset, in this case, we'll talk about the S&P 500, is down 15%. So this is how it looks for these buffer ETFs. And same thing. Now here's an example, 9% buffer ETF. So you got 9% protection on the downside, but this is looking at, all right, well, we have an up year. So how does that work? And the upside potential for this example is 15%. So here the market ends up going up like 18%. You can see at the end of the year, that's where you'd be capped out at your 15%. But again, throughout the course of the year, there's a lot of volatility with it. Again, due to the option, the way options work. But if you hold it for that year, it'll perform as you expect to. So this is really just a mathematical calculation so that when you buy this thing, you have a pretty good understanding of what your upside is and what kind of protection you might get on the downside. But you do have to hold it for that full year. And when you start to look at the risk return dynamics, this is called the Innovator Fund, this PJAN. So this is Innovator, and it's a January to January buffer fund. So every January it resets. But this is a risk return here. So you can see return goes up this way and risk goes out this way. So here's the S&P 500. So you can see, it's quite risky. But from 2018 to 2022, you can kind of see here what you're getting with these buffer ETFs is essentially the risk level of bonds, but you're getting a higher return than those bonds. Maybe not as high as the S&P 500, at least over this period from 2018 to 2022, but you're getting lower risk with higher return. And that's kind of what you're trying to do with these holdings. So, good ways to use the buffer. So worried about market sell-offs, which is kind of exactly where I'm at with this. It does help you protect on that. It does allow us to, rather than maybe sit in cash or T-bills or something like that, we can put this money to work in these buffer ETFs. And does, if you prefer the safety of bonds, it does give you the opportunity, as I showed you here, you're still getting kind of bond-like volatility, but you're getting a little bit higher return. And kind of going along with worried about market sell-offs. So, if you're afraid of investing in high stock market valuations, this gives you the opportunity to protect, because usually once valuations get really high, like they are today, typically you're going to see lower returns, which means more volatility to the downside. And then, this is also something that can be really good for, I guess, retirees who don't want to have to worry about as much on the downside. So these are really innovative products that are coming out. And of course, they're doing it through the ETF structure, which I really love. I've been a huge fan of ETFs. They're much more cost effective. They're tax efficient. They're very liquid. You could sell them at any time. There's no credit risk, meaning that there's no third party you're depending on. It's not like it's put out by Goldman Sachs. It's all using these options that are sold on the markets and the CBOE, the Chicago Board of Exchange. You're not locked up to anything like you are with equity indexed annuities. There's no commissions. There's no surrender fees associated with it. And fortunately, this one's a 1099 and not a K1, so that's always good. Okay, so I'll talk more about that, but I'm looking to implement some of that just to try to protect some. But if folks want to get some more equity exposure, and I understand that, it hasn't worked out for me the way I thought it would this year. But we'll try to do some stuff, but I'm still going to protect on the downside. But okay, so next topic is, I got questions. What's it mean with the downgrade? So Fitch downgraded the U.S. debt from AAA to AA plus. It's still, high quality credit, but it's kind of a shot across the bow in my mind that they're letting the U.S. government know that, hey, you got to start to think about this a little bit. The reasons they pointed to the downgrade is rising deficit levels. So, basically we've gone from 3.6% of gross domestic product to 6.3% in just over a year. And they're expecting to continue to go up to 6.9 by 2025. They also said erosion of governance, which basically means they don't trust the idiots in DC. And I don't think most Americans do, but they just look at, having all these, nobody does anything in advance. It's always like a panic at the end, debt ceiling fights and all this. So they're actually acknowledging that our debt to GDP is currently at 112%. So that means we have 12% more debt than we have all economic activity. And I've talked about this numerous times in the past, but they're expecting that that's going to go up to 118% by 2025. In fact, I just read an article like we are going to have a daily deficit of $5.3 billion for the next 10 years. Let me think about that. Daily. Wow. They also expect a recession here either at the end of this year or the start of next year. So that's going to put a big drain as tax revenues drop, but yet spending continues to go like it is. And that's assuming they don't do any more stimulus if we do go into recession. And the other big thing is, higher interest rates are going to have a big impact because the vast majority of U.S. debt, and we talked about this a couple months ago, the vast majority of U.S. debt is due to mature within the next 3 years. So we are going to be rolling over most of our debt at these, if the rates stay where they're at 5% per year. So our interest costs are going to explode even higher. And we finally hit a point right now where our interest expense is as high as what we spend in the Department of Defense. So that's pretty crazy. And right away, the bonds kind of reacted to it. If you look at the far left of this chart, I mean, they basically dumped and went back to the lows that we saw in September of last year. This is the 20-year Treasury ETF. So they immediately impacted that. Now, I think there's other factors at play why bonds got hit too. I'll talk about it. I think inflation's starting to rear back up. So I think the bonds are starting to think, Fed's not going to back off. The bond market is always the smart market. Stocks follow bonds. So I think they're worried about inflation peaking back up. And then with Japan, the Japanese central bank finally stopped their yield curve control. I mean, before they wouldn't let any Japanese government bond go above 0.25% in interest. And now they're going to let it go up to 1%. And the thought process behind that is now more people, even though it's 1%, at least more Japanese investors will invest in Japan versus buy treasuries here. So those three factors, the downgrade, inflation rearing back up, and the Japanese yield curve control going at least moderating, I think that hit bonds pretty hard. But when bonds are starting to get hit like this, you're going to start to see stocks probably take it on the chin too. And this is just a little quote from Market Watch that, we just borrowed over $1 trillion this last quarter, which was $274 billion more than we anticipated in May. So it's just a horrible situation. So I mentioned, inflation peaking back up. And there was a good article by a guy, John Malden, a week ago. I mentioned John as something that I read every week. And, the inflation numbers have been getting better. But the biggest reason that they're getting better is because all of the inflation numbers are comparing it year over year. So, when they release the August CPI number at the end of this month, the increase or decrease in it is all compared to what it was in August of 2022. So this gives you an idea of month to month from 2021 to 2022. And you can kind of see the differences. It peaked in June of 2022. It was 9.1% higher than it was in 2021. So that's how this thing works. It's looking back at previous years. So this was the inflation rate for 2022. And now we'll look at 2023. And you see the number, if you look at the very bottom, the green, where it goes from 6.4 to 3%. Yeah, it's getting to be less. But remember, it's only comparing it, to the prior year month. So this year, or this June, it was only 3%. Which sounds phenomenal, but that's only because last June was when we had 9.1% inflation. So it has gone up 3% from that horrible 9.1% figure. So to give you kind of an idea, if we stayed at 3% inflation rate just for the rest of the year, so from July to December, just naturally comparing it to the previous months, we're going to see the inflation rate tick back up naturally to 3.2 all the way up to 4.3. That's if everything stays exactly kind of the same. We just see that 3% annual rate of inflation. So it's all compared to, the previous years. And again, June of 2022 was the horrible month. And things got better after June of 2022. So that means that if we see its consistent 3% annual rate, we're going to see the inflation rate tick back up naturally, just based off the year-to-year comparisons. and probably one of the reasons why inflation did come back last year, probably the biggest reason, was crude oil prices. Again, you see that top spike in crude oil prices. It's June of 2022. So, oil hit almost 120 a barrel back in June of 22, and then it's dropped back since then all the way down to low 70s up until June of this year. So that's been that matches exactly with the inflation rate that we're seeing. So, that it should be helpful, but the problem is we're starting to see oil spike back up. This is the XLE, which is the ETF when the top oil producers. And you can see it's starting to jump back up. We've got oil that went from the low 70s to now it's breached the 80 per barrel mark. So it is actually going up. So that's probably going to have a negative impact. You might notice that at the gas station. One reason is for the price increase, Saudi Arabia is still going to keep 1 million barrels a day less than they normally output. So they're going to continue that. But it's also here in the U.S., we are shutting down oil and gas rigs. We've been shutting them down now for 6 months, really since the start of the year. So the price of oil has come back to the point where it's not really feasible to keep these things online. So they've been taking these things off. Very steep decline. The COVID recession, you saw a bigger drop, but we're pulling a lot of oil rigs off. So that's going to limit the supply, which is going to cause the price to go up. And an interesting thing, this chart, really busy chart, apologize for it, but we're starting to see with this price increase just this month, we're starting to see gasoline usage go down. So the very dark black line is this year. The only other time it's gone down, if you look the gray line, which is from below that from 2022. Now in 2022, you can understand why gasoline usage went down in the summer, which is a very rare event. It usually does not happen. But, that's when, oil was $120 a barrel. So people were cutting back because of the cost. Well, they're cutting back now. So is it due to the cost? I mean, oil has gone up to the low 80s per barrel, but that's not 120 a barrel. So is it endemic of the price increase, or is it just the consumers tapped out? Because usually in the summer, with travel and everything like that, you see this number go up. And if you look at every single year thereafter, that's what you've seen. The sort of the green line there for 2021, you can see it spiked really big time in the summer because that's when COVID kind of died down and people were getting out and traveling again. But even the other years before that, you can see during the summer, gasoline usage went up. So it's something to keep our eyes on for that. And, as far as investing, I think I'm going to start adding back into oil. I've mentioned that. I still think oil, I've been saying this all along, oil is a very good value. And if it starts to spike back up, we'll get more into oil. And this is comparing oil. So this is the XLE divided by the QQQ, which is tech stocks. And it's broken a trend recently. So are we getting back to where value is outperforming growth like we saw in 2022? I mean, this is too soon to tell, but it's definitely something to watch. And then the other factor that's kind of going to hurt the inflation numbers right now, this is agricultural commodities. So you can kind of see when it peaked last year in 2022, but it's steadily climbing back up almost to the peak of what we had in 2022. So food and energy go back up in price. That's not going to bode well for inflation. Okay. So the last thing I was just going to chat about is, and this is more just something funny. So I've got 2 daughters, and they, along with all their friends, are just crazy about seeing Taylor Swift. It's just a phenomenon. Her tour is going to pull in more than $1 billion. And it's an amazing effect here. And the biggest area that it's affecting is the travel. So this is looking in May of 2023. kind of the Taylor Swift effect. And it's looking at hotels, the revenue growth from the year before. And you can kind of see, so Nashville and the rest of the U.S. is, 3 to 4% growth over the year, which is good. Nashville did not get a concert with Taylor Swift, but Boston, Philly, and Newark did. And you can kind of see what the hotels did. So during that month when Taylor Swift was there, they saw more flights into the area. They saw more hotel revenues. Restaurants were full. In fact, it's so crazy. There are countries begging Taylor Swift to set a concert, and Chile is basically trying to figure out a way to get her to come down there to do a concert, because everybody can see when she shows up. So do the visitors. And anecdotally for me, I had one daughter. My oldest daughter was studying in Italy, so she was still over there when my youngest, in May, she went up to Philadelphia. So with some of her friends, and my wife took them up, and they had to get hotels, and they shopped, and they went to the restaurants, and my credit card got just abused. But they did that, and my oldest, as I mentioned, she's here in Knoxville, finishing up her internship, but she actually flew up to Pittsburgh to go see a concert there. She had some friends that go to college there. So she went to Pittsburgh just to see her. So it's just kind of a weird, funny thing. It may not affect any of you if you don't have kids or probably particularly daughters. But it's, she's a huge economic boost for areas, without a doubt. Okay, so I appreciate your time here. I know I'm probably running a little bit long. See if there's any questions. Okay, good question. Why is a 1099 better than a K1? Well, first off, the K1s usually don't come out until March, sometimes late March. K1s are also, so on a 1099, you get that by February 15th. And it's also incorporated with all the other stocks and bonds. So it's much easier for your CPA to deal with that. K1s are very complicated because technically it's ownership in a company. So there's lots of factors that your CPA is going to have to look at, depreciation, amortization, all these kind of little things that get pumped in there. So they're always a pain for the CPA. They always charge you more for K1s, and they don't come out until late March usually. We had that happen this year for clients, and I didn't think they were going to issue the K1 this year, but they did. So that's one of the big reasons. And then another good question, is there anything to keep us from printing more money to cover the deficit? And that's exactly what they're going to end up having to do. At some point, the fiscal deficit is going to get to the point, if it gets to the point where we don't get outside investors, pension funds, other countries, everything like that, and rates start to climb really fast, which would cause serious economic issues, the Federal Reserve is going to print money to cover that, which also is going to have serious issues because it'll be inflationary. So they are going to eventually end up just printing that money. There's no doubt about it. Okay. And a question, where am I? I'm at a Starbucks in Knoxville, Tennessee. We're picking my daughter up from her internship. So they were packing up the room, and I didn't want to be there to try to do it with. She was in a house with 6 other girls. They're all packing up. Like, there's no way, even as busy and noisy as this road is out here, it's probably not as noisy as probably 6 or 7 women try to pack up and move things around. So I just came up to the local Starbucks here to do this. So but that's where I am. So appreciate your time, and I'll talk to you all. We'll have another one of these in 2 weeks. So take care, everybody.